finish up chapter 4 today. We just have a couple of additional learning objectives here to go through. You guys are such quick learners. We're just zooming through. If I'm going too fast, so you gotta let me know. Okay. All right, so another one of those adjustments is alimony. So what exactly is alimony? Well, it's a payment from one ex-spouse to another ex-spouse that is not child support. So it has nothing to do with children. It's for like maintenance of lifestyle, or maybe one of the spouses had never worked and sacrificed their career, and now they don't have really any earning potential, and so the other spouse is obligated to pay some sort of alimony. So alimony, usually when there is a divorce, there are three main types of payments that occur. One would be alimony, although alimony is not as popular or as common as it used to be. Another is child support, and that is for the maintenance of children, payment for their food, shelter, clothing, all of that stuff. And then also property settlements. Property settlements are when the spouses own property together, and then that property is divided. So think house. If a divorced couple owned a house together, one of the spouses may stay in that house and then has to pay off the other spouse for their half of the ownership of that home. These two, property settlements and child support, are not taxable events. There's no tax on child support payments that are received, and there's no deduction for child support payments that are made. Also, property settlements, there's no taxable event that happens there, because essentially what's happening is that the spouse that is receiving the settlement, they're just receiving their own asset, right? They already owned half of that house, so it's not, it's nothing new has really changed there. But it is important to distinguish between them. Sometimes, well, this doesn't really happen as much now as it used to, but there were times when alimony would be disguised as a property settlement, or vice versa. And I'll tell you a little bit about it has to do with how alimony used to be treated, that would occur. So child support is payable, and it has an end date to it, like when the child turns 18, or when the child turns 22, or when they finish college, or something like that. It's always associated with the child. I said a property settlement is just a division of that property. Alimony used to be taxable to the recipient and deductible to the payer. So if you had to pay alimony to a spouse, you would get a tax deduction for that, and if you received alimony, you would have taxable income for that alimony. Now, it was kind of a way to shift income as well. So if one of the spouses was in a lower tax bracket, it would be more beneficial to get the deduction at the higher tax bracket, and then you're paying income on tax on it at the lower tax bracket. So that's when these property settlements sometimes were used to disguise alimony, or to make a property settlement into alimony, because there was some tax planning advantage that you could have. Now, since 2019, alimony is no longer taxable to the recipient and no longer deductible to the payer. However, this was grandfathered in. So for those who had a divorce settlement that included alimony before, and it was executed on or before December 31st, 2018, for those individuals, it is still deductible and taxable. Now, they can choose to execute a new, if somebody is still under the old regime of it's taxable and deductible, and they don't want it to be taxable and deductible anymore, then they can execute a new agreement where if they do that, then it will not be taxable to the recipient or deductible to the payer. But because there's still a lot of agreements out there from before that time, it's important to know how alimony is, how it's deducted on these returns and it's a for AGI deduction, so it's one of those adjustments that does affect AGI. So what exactly is alimony? In order to qualify as alimony, there are certain requirements. The payment has to be in cash. That doesn't mean that you gotta it's gotta be, in bills. You gotta get your bands out and pay it that way. It obviously could be a check or a transfer or that sort of thing. But it has to be in cash, and it has to be required under the provisions of a divorce decree or a separate maintenance decree, or the provisions of a written separation agreement or other decree. So it has to be legally required. It can't just be an agreement between the two parties, right? There's got to be some sort of legal requirement to make this payment. All payments must occur after the decree or after the execution of the agreement. So if it was executed, now this isn't really an issue anymore because this only pertains to agreements that were from pre-2018 anyway. But before 2018, what it would mean is if you say you got divorced in October, but you had been making payments to the other spouse before a decree was actually finalized, all of those payments before would not count as alimony. Only those payments after the decree is finalized would count. All payments have to end with the payee spouse's death. So, and it has to state it in the agreement that upon XYZ spouse's death, there are no further alimony payments will be due. There can be no provisions to make payments to the estate of the spouse or in any other manner after the date of the death of the spouse. If that rule, if it's not in there in the agreement, then none of the payments are considered to be alimony. Alimony also includes payment. Now we said up here that it has to be in cash, but it doesn't have to be directly paid to the recipient. It could be paid to a third party on behalf of that recipient under the terms of the agreement. That means that the individual paying the alimony can make rent payments or mortgage payments, property tax payments on behalf of that other spouse, and it would still be considered alimony. So it's still a cash payment, but it's to a third party on behalf of that recipient, right? And those payments, if it's made to maintain property owned by the payer spouse, but used by the payee spouse, does not qualify. So the individual who's making the payments can't then use the property at all for personal purposes. So they can't make the mortgage payments, but then they're still living in one of the rooms of the house. Okay? That would no longer be considered alimony for these purposes. Payments are not alimony if the spouses file a joint return or if they live in the same household when the payments occur. So they do have to be separate. A payment made when spouses are living together and one spouse is preparing to leave the household and does so within 1 month after the payment, that counts. Okay? And if the spouses are not yet legally separated under divorce decree, a payment is made under a written separation agreement, that payment will count as alimony even if the spouses are members of the same household when the payment is made. So there's some a few little legal exceptions in there. Also, if the divorce decree or the maintenance agreement specifically says this is not alimony, then it is not alimony. You can't make it into alimony, even if it meets all those other criteria. Okay. Let's see here. Here we've got Akeem and Taylor. Their divorce decree was final on December 12, 2018. So they're before that December 31st date. So that means that the alimony would be taxable and deductible. Under the terms of the divorce, Akeem transferred title on the couple's house to Taylor's name. The house was worth $100,000 at the time of the transfer. Divorce decree mandated that beginning in December 2018, Akeem has to make payments on the 12th of each month, $200 to Taylor for maintenance of the child, $400 to Taylor, and $800 mortgage payments on behalf of Taylor. Payments for the child will continue until she reaches age 18. Payments to her on behalf of Taylor will cease upon her death. They file separate returns. No modifications have been made. So this means it qualifies as alimony. How much can Akeem deduct in 2023 for the alimony? Well, let's take a look at all these. So the $100,000 transfer of the home is property settlement. It's not alimony, right? So that doesn't count for anything. $200 in child support, also, that is not part of alimony, right? $400 a month to Taylor, that would be alimony, and the mortgage payment of $800 to the bank would also be considered alimony. So how much can he deduct in 2023 for alimony? Let's see, the house was worth, mandated, beginning December 2018 on the 12th of each month. Okay, so it doesn't say anything about any payments before that time. So I'm thinking $1,200, the $400 of cash, and then the $800 mortgage payment. So for and this says, well, how much for 2023? Okay, so in 2023, this is ongoing. That means, so for all 12 months, he has made these payments. So $1,200 a month, $14,400. So Taylor has to include $14,400 as income, and that would go on part 1 of the schedule 1, which is other income. That's why, as well, you'll notice on that form, both on the part 1 and part 2. So part 1 of the schedule 1 is for income, part 2 is for adjustments, those deductions. In both areas under alimony, it asks for a date of the divorce. This is why, because the rules changed. So if the divorce happened in 2019, it doesn't matter, that none of it's deductible or taxable. So you can't change that. Whereas if it happened in 2018, then it could still be deductible and taxable, but as long as there wasn't a superseding agreement between them to go under the new rules. All right, so alimony recapture rules. So, and this again only applies to those that were in 2018 or earlier, those alimony agreements before that time. If the alimony payments decrease sharply in the second or third year of payment, the payments may be subject to a recapture provision. This means you've claimed a deduction, they're going to take it back. Okay? You're going to have to pay back any tax advantage that you had for those amounts. It relates to the concept of substance over form. In this case, the payments may be called alimony, but really they're a property settlement. So before that time, this is an example of trying to reclassify those payments to get a tax advantage. So it was really, if it was a large amount up front, maybe they're actually paying off the house, making payments for the house, but they're calling it alimony in order to get a deduction for it. Whereas with a property settlement, they wouldn't get that deduction. Of course, on the other side of it is somebody who's going to be paying tax, but presumably that would be at a lower tax rate. And there may have been, there could be some agreement between the two individuals of, hey, I'm gonna pay this, you're gonna have to claim it as taxable income, I'll pay the tax for you. I'll pay that back. But this is more advantageous for us. Recapture rules will reclassify payments from alimony to a property settlement. If it's required, the recipient who previously recorded income will treat the recapture amount as a deduction, and the payer who previously recorded a deduction will count the recapture as income. Okay? So essentially you're trying to call a property settlement alimony in order to get a tax advantage from it, and they'll come back and recapture it if that structure is detected. Okay? Questions about alimony? The dates are important for alimony. You got to be cognizant of the dates of the settlement and all that stuff, because it will determine whether or not it's taxable or deductible.
Are there questions that will have that, like, before prior to 2018?
I think there may, if I recall, I think there may be. Yeah.